Hi everyone. In this video, we are talking about inherent risk, one of the core concepts in audit and assurance. By the end of this video, you will understand where inherent risk comes from, how auditors assess it, and the two levels at which it's considered. Let's get into it. Let's start with proper definition. Inherent risk is the risk that items may be misstated because of their own inherent characteristics. Now, notice what's missing from that definition. There's no mention of controls at all. Inherent risk comes from the item itself or from the entity and industry it sits in. It never comes from a weakness in control. This is really common point of confusion, so make sure that distinction is clear in your mind. So when we describe something as having high inherent risk, what we actually mean is that the item is more likely to be misstated. And crucially, this is assessed before any control is even considered. Controls come later in the process. Right now, we are purely looking at the raw underlying risk. Let's look at the first source of inherent risk, the nature of the item itself. Some items carry high risk simply because measuring them relies on estimation rather than being based on precise countable figure. Whenever judgment is involved, instead of hard verified numbers, the risk of misstatement goes up. Here's a real life example to bring this to life. Think about a car manufacturer that has to estimate its warranty provision for all the vehicles it's already sold. Nobody can say with certainty how many of these vehicles will fail and need warranty repairs. So that figure has to rest on judgment rather than a precise count. And that's exactly what makes it inherently risky. The second source of inherent risk is the nature of entity and the industry it operates within. Some industries are simply more volatile and more complex than the others, and that volatility directly increases the risk of misstatement. Let's compare two examples. A mining company operates in a volatile, high risk environment. Commodity prices swing constantly, and reserve estimates carry a lot of uncertainty. Now, compare that to a regulated water utility, which benefits from stable, predictable tariffs. Both are legitimate businesses, but they start from very different points when it comes to the inherent risk, purely because of the industries they are in. The next point is really the heart of the whole topic. Inherent risk operates completely independently of controls. As an auditor, you cannot design a control that removes inherent risk. Instead, it has to be accepted as part of the client's reality. Your job is to assess it carefully and respond it through audit work, not through recommending a control, because inherent risk simply will not go away. Let's go back to the mining example. Ore reserves carry inherent risk simply because of what they are, geological estimates. Even the most sophisticated world-class systems of controls cannot make an ore body any easier to physically measure. That's the essence of what makes a risk inherent. So how does an auditor actually go about assessing inherent risk in practice? It really comes down to two main sources of insight. The first is knowledge from previous audits, findings from prior years, along with a journal familiarity with how the client's transactions typically behave, feed directly into this year's risk assessment. The second is an assessment of current environment. Here, the auditor looks around at today's economic conditions, pressures specific to the industry, and any changes happening inside the entity itself. A great real world illustration of this is 2020 when COVID-19 hit. Auditors sharply raised their inherent risk assessment across the retail and travel sectors almost overnight. And that happened regardless of what any prior audit had shown. It's a perfect example of the current environment overriding historic patterns. It's standard practice to assess inherent risk at two distinct levels, and it's really important not to mix these up. The first is financial statement level. This is big picture. It captures risk arising from the entity's management, its overall business model, and the wider economy. Risk at this level affects the audit as a whole. The second is the account balance and transaction level. This is the fine detail. It's about how subjective, complex, or exposed a specific balance or transaction is. Risk assessed at this level is what derives which balances receive closer audit attention. Let's zoom into the financial statement level and look at three key factors that derive risk here. Factor one is management integrity and skill. If you look back at the history of major corporate scandals, they consistently show how management manipulating profits elevates inherent risk through a fundamental lack of integrity. Factor two is the nature of business. For example, a fast scaling technology company that's entering new markets and launching new product lines faces inherently high risk than a long established business that's being selling a single product for decades. Factor three is industry and microeconomic factors. Rising interest rates and high inflation, for example, can push inherent risk up across almost every industry at once. And that increase has nothing to do with any individual client's own controls. Now let's move to the account balance and transactional level and look at three factors that matter here. Factor one is degree of subjectivity. Take an example of provisioning for a legal claim. This relies heavily on lawyer's judgment about how the case will play out and what it might settle for. That kind of subjectivity means high risk. Factor two is degree of complexity. For example, recognizing revenue on a bundled multi-year software contract is far more likely to go wrong than recognizing revenue on a single routine cash sale. Factor three is risk of misappropriation. Think about a warehouse full of small, high-value electronics. Items like that are easy to divert or steal, which raises the inherent risk around that particular asset. Let's bring this all together with four key takeaways on inherent risk. Number one, it comes from the nature of an item and from the nature of the entity and industry it belongs to. Number two, it exists completely independently of controls. The auditor cannot eliminate it, only assess it and respond to it through audit work. Number three, it assessed using a combination of knowledge from prior audits and an understanding of current environment. And number four, it considered at both financial statement level and account balance level. That covers everything you need to know about inherent risk. Thanks for watching, and I'll see you in the next one.